I've been analyzing financial statements for 20 years. In the beginning, it was really hard for me to make sense of the numbers. But over the years, I learned a few tricks that makes it easy to analyze any income statement in just a few minutes. In this video, I'll show you the layout of the income statement, the key numbers to focus on, and the simple trick that the pros use to analyze it in just a few minutes. Hi, my name is Brian Feraldi. I'm a financial educator who's been investing in individual stocks for more than 2 decades. Now let's start learning the layout of an income statement by using Home Depot's income statement as an example. Now all income statements have 3 major sections. The first is revenue. This is the total sales that the company generates during the period. Second is expenses. Companies list out all of their various costs and expenditures that they incur to produce those sales during that same period. And the third and final number is profit, which is simply revenue minus expenses. Now on Home Depot's income statement, it also lists 2 other numbers that are worth knowing. The first is the total number of shares that the company has outstanding. This figure can rise and fall over time if the company is issuing stock or buying it back. And another number that's worth noting is the earnings per share. This is simply the net earnings that the company generates during the period divided by the number of shares that are outstanding. Now, it's important to note that while all income statements follow the basic format of revenue minus expenses equals profit, companies do have a lot of leeway with the names, categories, and terms that they use when they're creating their income statements. This is why income statements can look different from company to company, even when the companies operate in similar industries. For example, let's compare Home Depot's income statement to that of Costco. Now, both of these are big established retailers that sell products that they buy from suppliers. So their business models are fairly similar. Now, at a high-end level, both of these income statements do follow that same pattern. Both companies list revenue at the top, then they list all of their expenses below that, and the bottom line is the company's net income or earnings that it generated during that period. However, looking at both of these income statements side by side can show us the choices that management teams have when they're creating their income statements. For example, Home Depot's management team chose to call its revenue net sales. This is the total value of products and services that were bought at Home Depot stores. By comparison, Costco chose to list out 2 sources of revenue. The first is net sales, which is the products that were sold to consumers at the company's stores. And the second revenue line item is membership fees that customers pay to have access to Costco's stores. Costco could have chosen to simply combine both of these together, but it actually chose to separate them out to give investors more insights into the business. Another difference is that Home Depot includes a line item called cost of sales. This is the total value of the inventory that the company bought from suppliers to put on its store shelves that were eventually sold to consumers. So included in here would be things like hammers, nails, ladders, and cinder blocks. By contrast, Costco chose to call this exact same expense merchandise costs. This is the total value that Costco paid to its suppliers to put their goods in Costco stores. So while these are the exact same expense, these 2 companies chose to call them different things. Another choice that Home Depot made was to show the company's gross profit as a line item on its income statement. Gross profit is simply net sales minus the cost of sales. So 152 billion minus 101 billion. By contrast, Costco does not show gross profit on its income statement. So if you, the investor, wanted to figure out how much gross profit Costco was making, you would simply have to take the company's total revenue, subtract out the merchandising cost, and that would give you the company's gross profit, which is $32 billion during this period. These 2 numbers represent the exact same thing, but Home Depot chose to include this figure on their income statement, but Costco chose not to. Now that we understand the layout of an income statement, let's turn our attention to the most important numbers that you'll see when analyzing an income statement. When a professional investor is looking at a company's income statement, the first thing they often do is look at the company's revenue. Revenue will tell you the overall direction of the business, if it's growing or dying, as well as if the company is cyclical in nature, depending on what is happening in the economy. Now, in Home Depot's case, they gave us 3 years of income statements, and we can see that revenue went from $151 billion in 2021 to $157 billion in 2022 and $152 billion in 2023. So the overall direction here is up, although revenue was down in 2023 when compared to 2022. Now, if you're an investor, it can actually be more helpful to get more than 3 years of data so you can draw conclusions as to whether a business is growing, dying, or cyclical. To figure that out, I'm going to head on over to finchat.io and enter Home Depot stock. Then I'm going to click over to the Financials tab. The income statement comes up by default, and I'm simply going to click on Total Revenues. Doing so allows me to visualize Home Depot's long-term revenue trend, which has been up and to the right. Better yet, FinChat will actually calculate the company's compound annual growth rate for revenue, which in this case is about 7% annually. So looking at this tells me that Home Depot is still very much a company that is growing. The second number I always look at when analyzing an income statement is the company's earnings per share. This is the net profit that the company generated divided by the number of shares that are outstanding. By looking at this number, I can quickly tell if a company is profitable, unprofitable, and the direction of those profits. Looking at Home Depot's income statement, we can see that profits were $15.53 per share in 2021. That grew to $16.69 in 2022, and then that dropped to $15.11 in 2023. If I want to get a longer term look, I'm going to once again head on over to FinChat, scroll down, and click on earnings per share. Doing so makes it obvious that Home Depot's earnings per share have consistently risen over the last 10 years. So while they've declined in 2024, the overall trend is up. Moreover, I can also see that Home Depot's profits have grown at a 13.8% compound annual growth rate over this time period. So Home Depot is growing its profits per share at a double-digit rate. The third number that I always key on when analyzing an income statement is the company's diluted share count. This is the total number of shares that are outstanding. By watching this number, I can tell if a company is issuing shares or, better yet, buying back stock, which would benefit me as a shareholder. In Home Depot's case, it had 1,058,000,000 shares in 2021, and that number shrank to just over 1 billion shares in 2023. That tells me that Home Depot's share count is declining over time, which means that it's buying back stock. By scrolling down in FinChat and clicking on the company's diluted share count, you can see that this trend has continued over the last 10 years. Home Depot used to have 1.346 billion shares outstanding. Now it has just over 1 billion. That means that the company's share count has been declining at a greater than 3% rate over the last 10 years, thanks to the company buying back stock. Now, this isn't to say that revenue, earnings per share, and the diluted share count are the only numbers that I pay attention to when analyzing an income statement. It can certainly be useful to pay attention to other metrics as well, such as gross profit, operating profit, and earnings before tax. However, I think that revenue, earnings per share, and the diluted share count can tell you a meaningful amount of information about a company with just a few numbers. Now that we know the key terms that I look at when I'm analyzing an income statement, the next thing I'm going to teach you is a simple trick that professional analysts use to analyze a company's financial statements quickly. Now, when you're looking at a company's income statement in absolute terms, it can actually be pretty hard to get a nuanced view of the company's profitability and how it's performing. This is why professional investors always perform margin analysis. Now, margin analysis sounds like a technical term, but it's actually quite simple. Margin analysis is simply taking profits and expressing them as a percentage of sales. By looking at a company's margins, it's much easier to spot trends, analyze the number quickly, and compare companies to each other. Now, while there's several margins that you can look at, there are three that I think are particularly important. The first is called gross margin. This takes a company's gross profit and, like all margins, it simply divides it by revenue. This tells you for every dollar in sales, how many pennies the company turns into gross profit. So let's calculate gross margin for Home Depot. In 2021, the company reported $50.8 billion in gross profit and $151 billion in sales. If we divide $50.8 billion by 151, we get a gross margin of 33.6%. Said differently, for every dollar in sales, Home Depot generated 33.6 cents in gross profit. If we do that exact same calculation for 2022, we see that the company's gross margin was 33.5%. And if we do that calculation for 2023, we see that Home Depot's gross margin was 33.4%. Now, by looking at gross margin over a period of time, we can actually see that Home Depot's gross margin is declining as time moves on ever so slightly. This could mean that the company is offering bigger discounts to customers, or it's unable to successfully pass along the price increases that its suppliers are pushing onto it. Now, even if that difference in gross margin seems very small, small changes in gross margin margin can actually have big impacts on the business. The second margin that I always look at is called operating margin. This is when you take a company's operating income and, like all margins, we simply divide by revenue. Monitoring this number can tell you how well a company is doing at translating revenue into operating profit. The final margin that I always look at is a company's net margin. This is simply the company's net earnings divided by revenue. Yet again, this tells you for every dollar in sales, how many pennies become after-tax profit at the business. Now, thankfully, there's no need to do any of these calculations yourself. You can use FinChat to do all of them. To do so, you simply click on Financials and then Ratios. Then we click on Margins, and here are the company's margins listed out. Now, if I click on the company's gross margin, we can actually see how the company's gross margin has trended over time. Notice that it has been declining over the last decade, from 34.1% down to 33.4% today. If we also include the company's operating margin and net margin, we can see a more complete view of the company's income statement. Notice that while the company's gross margin has been declining ever so slightly over time, the company's operating margin has actually been increasing, and the same is true of the company's net profit margin. This analysis quickly tells us that the company is doing a fabulous job at turning revenue into profits and is actually getting more efficient at it over time. Now that we know how to quickly analyze an income statement, let's take a look at ExxonMobil's income statement to see what we can learn. First, we're going to click on Financials, and then we're going to pull up the company's total revenue. Take a look at ExxonMobil's total revenue over the last 10 years. Notice that this figure goes up and down, which is most likely directly linked to the price of oil. In fact, over the last 10 years, ExxonMobil's total revenue has actually declined slightly. Next, let's pull up the company's earnings per share, where we see a similar story. Earnings per share is proven to be very cyclical, sometimes rising while other times falling, but the net long-term change is that it's barely grown at all. Now let's pull up the company's diluted share count. We can see that ExxonMobil does have a history of buying back stock sometimes, but in other cases, its share count has actually risen. So the net effect is that over the last 10 years, Home Depot has repurchased shares, but the share count has only declined by a fraction of 1%. That tells me that ExxonMobil is not focusing on share repurchases to return cash to shareholders. Finally, let's do some margin analysis of ExxonMobil and pull up the company's gross, operating, and net profit margins. If we look at the company's gross profit margin, which is the green line, we can see that this figure has actually been declining for the better part of a decade. Moreover, we can see the company's operating margin and net margin have both been up and down, most likely due to the cyclical nature of ExxonMobil's business. Sometimes this company is very profitable, like it was in 2022. Other times this company is very unprofitable, like it was in 2020. You can see that with just a few minutes of analysis, we can quickly tell if a company is worth investigating or not. Now, as I mentioned at the top of the video, companies do have a lot of leeways with how they lay out their income statements. In fact, some companies don't even call this document the income statement, referring to it as either the profit and loss statement, operating statement, or earnings statement. To make things easy to understand, I made a free infographic ebook that lays out all of the terms that you might see a company use when it's creating its income statement. If you want a free copy of that infographic, just visit longtermmindset.co/FSS ebook or click the link in the video description. Well, I hope that you found this video to be useful. If you did, give it the thumbs up. That really helps us out on YouTube. And if you want to continue learning from here, I highly recommend you watch this video next.